Yeah, welcome everybody. I'm very happy to be able to chair this session, and I'm very happy that Frank, Philip, and James have agreed to participate in this session, which I think will be very exciting. I shouldn't say too much. Volker already gave a brief introduction, but all of you are both renowned economists in the academic sphere, and you have worked at central banks and partly decided policy directly or indirectly. So James Bullard is now at Purdue University, but was at the FOMC and the St. Louis Fed. Frank, I think you have been there since the beginning of the ECB as economist, chief economist, advisor in various functions, now at the BIS in Basel. And finally, Philip Lane, professor and also central banker, known for his research and known for his policy work. Bank of Ireland, before you became the chief economist here at the ECB. So I think you are very well equipped, so to say, for the topic of the session, monetary policy amidst trade shock, rising debt, and Volker chose this title, Diverse Drivers of Inflation. I think nowadays that's the only characterization we can give because we don't know what happens next month. So I would like to give you the floor. Maybe we start with James first with his statement. He had the furthest to travel. Or, sorry? Sorry, of course. Philip has to start the session, and then maybe James, and then Frank. Thanks. It's good that Volker's here. Okay, thanks a lot. The floor is yours, and you have about 15 minutes.
Okay. Good morning, and maybe indeed it's natural that I begin this session because it's a follow-on from President Lagarde's speech. But I'm going to be the pictures guy, not the text guy. So I'm going to focus on different slide presentations once it comes up. Oh. Okay, perfect. So maybe just to start off with the scenarios, what you see here on the screen are the ingredients into these scenarios. But let me, before I go into detail, just reiterate what the President said. We don't try in any given publication to span the full probability distribution. But I would say internally, we do try to span the full probability distribution. So these are illustrations to capture basically what is an important focus, the interaction between the size of the shock and the propagation of the shock. And I think the scenarios do a good job on that front. But of course, and again, President Lagarde's speech goes into it, there's other mechanisms that could turn out to be decisive, including the demand developments in financial conditions, and again, as the President already said, we will be, considering every meeting what, at the time of that meeting, what are the scenarios that really help us to address the kind of prominent issues at hand. So having said all of that, I mean, I do think the staff have done very good work in developing these particular scenarios, and essentially, again, the idea is to have plausible, realistic scenarios which are basically calibrated to capture different levels of kind of escalation of the issue. And essentially, going back to when we think about nonlinearity, essentially what you have to think about are interaction effects. I mean, the larger the shock, essentially, the more plausible that you get stronger interaction effects, stronger indirect effects, so the broadening of inflation, and then stronger second round effects, which kind of increase persistence. So let me say that from the point of view of when the exercise was done with the cutoff of 11th of March, essentially the severe scenario looks not too far different to the 95th percentile of the oil price distribution at that time. And the adverse scenario looks not too different to the 75th percentile. Though in the adverse, the price comes down more quickly. So these are not small differences to the middle of the distribution. These are significant, in order to really test what the dynamics would look like with significant moves. And so in terms of scaling, and it's important for the euro area to have a full understanding of energy prices, gas, electricity, fuel. So the synthetic price index I'll come back to, but you can see the severe scenario, it's still not at the level of 21, 22. So that's one basic fact or observation. Of course, let's see where this war takes us in terms of scale. But in terms of the severe scenario, it's a big shock, but it's scaled to be short of what happened in 21, 22. And maybe I would also say, when we think about the impact of the big macro variables in these scenarios, in this slide, I present it as deviations from the baseline. In the next slide, I'll also talk about the baseline, but as you know, the standard way to present scenarios is, the baseline, what are the additional dynamics coming from these add-on scenarios? And let me emphasize, there is significant hits to GDP this year and under severe scenario in 27. So there is a kind of impact on the economy. But you also see that the energy element is in the middle chart is really the biggest issue is going to be the size of the energy shock. The propagation matters, but it's really the most important thing is the size of the energy shock as a driver. And so let me present the growth profile in a different way here. So here, the light blue line is what we believed in December, which indeed might have been close to what we believed if this war had not happened. There was not a huge amount of news before the war. And compared to that, what you see is this V-shape in this year, in 26, in those scenarios. So a kind of really big hit, but then recovery, because especially in the adverse, the shock, it doesn't last forever. And again, for all of us, thinking about how long is the intense phase of the war going to last is an important issue. And you can see on the right chart, when you convert it into levels, in terms of compared to the trend we expected to see, all of these paths are below the 2025 projection for the trend. And again, we focus on annual average numbers in our main communication, but when you look at the quarter-by-quarter evolution of the annual inflation rate here, again, peak inflation does matter. I mean, under the baseline, peak inflation is around 3% fairly soon. It's around 4% later this year under adverse, and it's over 6% early next year under severe. So again, meeting by meeting, that peak effect will matter for formation of expectations and so on. And as you can expect, core inflation will move more slowly, but this is where the second round and indirect effects kick in later on. But these are, again, fairly big deviations if these scenarios hold up. Okay, let me move from the scenarios to what are we seeing so far. And as the President said in her speech, when you do this in terms of comparing to other major geopolitical events, this is not like the Russia-Ukraine war, where that's such a big shock. It was on the European continent. The drop in consumer confidence in the first reading was quite big, but it is bigger than the Gulf War. It is bigger than 9/11. So this is in between, as was already indicated. And again, let's see how this demand indicator and other demand indicators evolve over time. In terms of PMIs, we do have PMIs readings now, and if you reflect over the last year, we've been encouraged by improving PMIs. So the dotted lines are kind of the pre-pandemic average over that golden period of 2015 to 2019. But you can see that this downturn in the most recent reading. And I think the commentary around the PMIs is maybe the manufacturing sector has maybe been held up a bit by some anticipation effects, where people fear future supply chain problems. In terms of inflation expectations, I'm not going to show the consumer inflation expectations because we don't have readings published yet from after the war, but I'm sure you will be at your computer at 10 a.m. on Friday for the latest edition of the Consumer Expectations Survey. So this is, I guess, people in this room maybe contribute to forming the market view. And again, here I compare it to Ukraine. And this is, the way it's phrased here is in the first 16 working days after the event. And what you see here is of course, the spot effect for the first year is significant. But then when you go like 1 year, it's smaller and less than in the Ukraine. And then 5 year, it's more secure. Let me say again, part of the memory bank people have is, yes, inflation rose quite quickly, but in the end, it came back down. It did come back to 2%, including through our contribution. So, I'm not too surprised where there's confidence at the longer end, because they've seen a large inflation shock unwind. So there's an issue about the peak, but a lot also depends about persistence. And what we said last time about a timely return to target is, I think, important for that. I think it's interesting to do month on month on the right, because the annual inflation numbers, of course, have a lot of inbuilt persistence. So what you see here is in terms of the month-by-month calendar, January through December, what we have here is the market is expecting in March and April high month-on-month readings with kind of fuel pass-through and so on. But basically that's it. Then the rest of the year, it goes back to normal. So that essentially means it's a price level jump effect according to the market pricing. It's not embedded in the persistent component of inflation. In the annual inflation number, those 2 months of high readings means the annual inflation number will be elevated for a while. But the dynamic is essentially a price level jump, and that's it. According, not to us, according to the people who trade these contracts. An interesting issue is how big is this change in the synthetic energy price index. So there's a paper by a group of ECB economists from last year, which basically did a fairly advanced econometric study about what is a large energy shock. And essentially here, a mid-sized shock is about a 26% jump in the index. A large shock is about a 70% jump in the index. And what you see when you look at the whole history of energy shocks in the euro area is you sometimes have plenty of medium shocks, you have a number of large shocks, but not many are persistent. So in other words, there's a lot of spikes which then reverse quickly. But the exception is, again, 21-22, where it went high and stayed high for a sustained period. So the question is going to be on this occasion. So the last observation here is what was true on March 11, which is basically on the edge of a medium shock. If I did it this week, I think it's more like on the around and large shock. But you need the second condition about how long is it going to last at that point. And essentially in this paper, that large, medium and large shock element is essentially where the nonlinear adjustment kicks in. You get a degree of nonlinearity at medium, you get even more nonlinearity at large. So again, very nice work by the staff. Okay, so as mentioned, I think it is informative to look at the survey evidence about selling price expectations. Because again, it's hard to have inflation unless firms actually raise prices. It's a pretty direct causal mechanism, or at least proximate mechanism. And so when you think here, the first thing I'm reporting here is because they all have their role. The Commission survey is 3 months ahead. Are you planning to increase prices in the next 3 months? And it usually hovers between 0 and 10. And then what you see here is, it really climbed quickly to 60% in April 22, and then it took time to come down. So, honestly, the open question is going to be how, when as it climbs up, what becomes a critical thresholds. And of course, in our data set, we only have really one observation. And the issue is, where does it become an issue of concern versus normal fluctuations? And you also see between, with services, the peak was a lot lower. We know services moves more slowly. It's a very heterogeneous sector with many different components. But I think, understanding what we see coming up in the context of this time series will be important. We like our corporate telephone survey. These are very large firms, but we have a rich interaction with them. It's a very interesting survey, and we'll have a new one for April. And again, it's qualitative. But maybe a couple of points here is, yes, there's a big role for input prices in driving output prices. But the correlation is not perfect. And in particular, you see in recent years, even when the input price pressure calmed down, there were still output price increases in the pipeline, because sometimes the first response to absorb the input cost increase, and only later on do you adjust your selling prices. And maybe with the PMI, the composite, what you see here is the input price reading is basically nearly always above the output price reading. So sometimes firms absorb a cost increase, sometimes they pass it along. So understanding both the input dimension and the output dimension will be important. And again, this is just going beyond the composite to manufacturing and services, but the basic story is there. Let me also advertise our own firm level survey, and we'll have a new one in April. And this is basically, those surveys so far are qualitative. This one is quantitative. How much are you planning to raise your price? And so I think it's super interesting. These are not all consumer-facing firms, so it's going to be at different parts of the production chain. So that it will need some interpretation, but I think it's highly informative. And then in terms of second round effects, let me make a couple of points. One, I think the Indeed indicator is a leading indicator. It's proven that even though it's only one part of the overall distribution, people are taking new jobs. That element, when you study the data, has been a leader for the overall wage developments. So I think that is relevant. I think you can have confidence that the wage tracker is a pretty good guide to negotiated wages. So I'll let you, in your leisure time, look at the footnotes, which kind of explain these graphs. But the basic message is tight connection and also good leading indicator properties from the wage tracker ahead of negotiated wages. And then I would say maybe compensation per employee. There is a wage drift element which has moved around. So again, wage drift, we don't really have a leading indicator for that. But that is an element when we get the Q by Q national account data will be important. It's proven to be important, but it's in the end, it's a lot smaller than negotiated wages. So negotiated wages will be a very important part of this. So with that, I think maybe the last thing I'll say is I didn't show financial conditions here. That is clearly also something we will need to keep an eye on. And here we will have the bank lending survey, for example, at the time of the April meeting. So April, June, ongoing, lots of data coming in. We mean it when we're data dependent. And I think beyond the first order issue about the duration and scale of the war, and in turn the connected effects on energy prices, how these things propagate across the economy. There's many hypotheses, many scenarios, and so being guided by how the data is unfolding will be important. Let me stop there.
Thank you very much, Philip. And our next speaker is James Bullard.
Well, Thanks very much. It's a pleasure to be here, and I'm looking forward to a robust discussion, as always, with this group. I thought what I'd do in this slide deck is just pick up some data and some charts that are making their way around financial markets and use that as a way to comment on some of the issues facing the U.S. economy. This is just a summary, so if you just want one slide and you want to check your email, you can just do this slide. I would say the outlook is bullish despite the war, and I'll give some charts on that. I think trade uncertainty is lower, has moved off, certainly moved off the front page. There are fiscal policy tailwinds in the U.S. that are strong. There's an AI boom going on. I've got some charts on the AI boom. I would say an important factor in looking at U.S. labor markets is that the immigration policy has changed dramatically with the new administration. And we'll talk, there's a nice study on that. I'll talk about that. U.S. inflation, unlike the ECB, U.S. inflation is above target, has been persistently high by the committee's favorite measure. We'll talk about that a little bit. And as you guys know, there's a lot of political uncertainty around the Fed, and I've got a couple slides to talk about that. And of course, sprinkled all the way through, there are risks from the war that are substantial, and I've got various comments on that as we go through this talk. So that's basically the outline. So this is from Federal Reserve economic data at the St. Louis Fed. This chart goes back to 2023. This is weekly data on the Lewis Merton's stock indicator of U.S. GDP growth. So this is kind of more of a real-time indicator of what's going on with real GDP. And as you go from left to right in this graph, you can see this is drifting higher. And in particular, in 2025, it's been running higher, around 2.5, and the latest readings are still around 2.5%. That would be a year-over-year growth rate, real GDP growth rate for the U.S., according to this indicator. So I take from this is that at least coming into the shock, the war shock, the U.S. is growing at an above-trend pace. The potential growth in the U.S. is usually thought to be 2%. I think it's fair to say the incoming administration is pro-business or pro-economic growth. They want to do lots of things to try to promote growth. And you're seeing that in this chart here. So that's sort of the initial condition. Why are these, why is growth thought to be high in 2026? One factor is the BBB, the Big Beautiful Bill. The Republican majority had only one chance to pass by simple majority a fiscal policy. They did so last July. That bill, called the Big Beautiful Bill, adds, according to the Congressional Budget Office, adds 1 percentage point, almost 1 percentage point, 0.9% to the growth rate in 2026. So it's quite a bit. And so that's why we say there are fiscal tailwinds in the U.S. Retail gasoline prices, I've got a picture for you, have increased. And usually that's considered a bad thing, a sort of tax on consumers. Certainly, we all have to pay the higher gasoline prices. Demand is relatively inelastic. But I think there are mitigating features around that. The U.S. is a net exporter of petroleum products, not an importer, so it's not the way it was, and certainly in the 1970s, 1980s, and also not the way even it was 15 years ago, as the U.S. has become a leading producer of petroleum products and crude oil. And I think you need to keep in mind that energy intensity is much lower today than it was when you're looking at the historical record, post-war era in the U.S., way down from where it would have been in 1980 and down substantially even from where it would have been in 2010. So So those factors, I think, together mean that an energy shock isn't quite the same thing that it would be in the historical record. And finally, another bullish factor that people sometimes overlook is that the U.S. wealth to disposable income ratio remains high, and I have a picture of that for you. So here's the gas prices, not retail level gasoline prices. This is a Federal Reserve Economic Data chart. This goes back to, if I can read it correctly here, 2021. And so you do have the Russian invasion of Ukraine here on the left-hand part of this chart. You hit about, in the US, you hit about $5 per gallon. It's always sold by the gallon in the US. You know, you can see on the right-hand part of the chart that, you know, gasoline prices have gone up very dramatically during March here, but we're not really at the same level that we were at in the earlier peak. And you would have to get quite a bit higher, up to $5. And also, there's a lot of inflation moving from left to right on this chart. So if I put this in real terms, you'd have to, the peaks would look smaller on the right. So I don't think at this point that you've really got a shock of any particular magnitude. And I think Wall Street is looking at that. They're saying, well, you know, if this ends soon, then we don't really have a shock that we have to contend with. So I think that's one thing to keep in mind here is this picture. Of course, this could jet higher here. That's the risk. This could go much, much higher depending on how developments proceed in the Strait. Here's the high U.S. net worth. This is the chart that's often used. Supposedly Warren Buffett's favorite chart, so you should take note. The wealth to disposable income ratio in the U.S. In the post-war era, earlier in the post-war era, this ran at about 5.5, at 550 on this scale. And now you're close to an 800 on this scale. So what does this mean? It means that the value of the U.S. housing stock is extremely high because housing prices are high in the U.S. They're not coming down either. And the value of the U.S. equity or the U.S. corporate sector is also high. So those two things together are pushing this ratio very high. So for at least the top half of the income distribution that owns these type of assets, they're feeling very flush, and they're doing most of the consumption. So from a macroeconomic perspective, this is very bullish for consumption strength. You've also got people on the lower end and younger people that don't have these kinds of assets, so this is not going to be driving their consumption, but still, from a macroeconomic perspective, this bodes well for consumption. Tariff uncertainty certainly took a turn higher. The Supreme Court in the United States invalidated the use of the imposition of tariffs by the law that the Trump administration was using. My interpretation of that is that it was widely anticipated in financial markets, and even us non-lawyers could look at the Constitution, which says that the trade policy has to be set by the Congress, and Congress has delegated some of that to the executive, but certainly not wholesale delegation to the executive. And the Supreme Court came down on that side of the decision, and now the administration has to go to other legal means of imposing tariffs, which they have done. So this just says that tariff uncertainty went way up again, close to the March-April or April-May levels of 2025. That's what this chart is saying. But I don't really think, since it was widely anticipated, I mean, I think this picture is probably based, I actually don't know exactly, but I think it's based on mentions of trade and trade policy. So I don't think this is the right metric. I think that you should look at this picture instead. This is from The Daily Shot, which a lot of these are from the Daily Shot. They've been published there. I would recommend the Daily Shot to you if you like charts. This one suggests, is an estimate of the effective tariff rate imposed by the U.S. on incoming goods. And you can see this moves around, and there are many, many junctures at which this changes. It's not even really that easy to calculate the effective tariff rate because all these subsets of goods and the exceptions are being made and what's actually being collected. So I would say basically the effective tariff rate has drifted lower, and if anything looks a lot more stable than it does on the right-hand or the left-hand side of this graph. The right-hand side of this graph looks a lot more stable. So I would say trade uncertainty has probably declined. People know what the game is and how this is going to proceed, or they know more about how this is going to proceed going forward. So on the AI boom, a lot of Silicon Valley talk has been that, I don't know exactly what's going on, but a lot of negative talk about AI, and AI is going to destroy jobs, and AI is going to replace probably everybody in this room, and all this kind of talk. I don't think this is the right way to think about technological change. This chart is also from the Daily Shot and Goldman Sachs. This is an estimate going back, comparing 1940 to today, and which jobs existed in 1940, the light blue, and which jobs did not exist in 1940 but do exist today, the dark blue. And you can see, most of or many of the jobs, at least half of them, didn't exist, and probably a lot of the kinds of jobs we're all doing here in this room, were jobs that didn't exist in the past. So I think when you think about all the technological change that occurs, yes, some jobs go away, some things get automated, but new things come up. So I think the better way to think about AI is that it will be like all other technological change that has occurred historically, and some jobs will go away, but new jobs will be created. And therefore, I think also likely to increase productivity, and we're on the cusp of a productivity boom coming from AI. So we can talk about that more maybe in the comments. This chart from Halcyon is almost tongue-in-cheek about the size of the hyperscaler build-out of data centers in the US. So according to this chart, this is 2.1% of GDP in the US only in 2026. So just for 1 year, you're going to spend 2.1% of GDP just building physical space for data centers. So I've been saying since last summer, this sounds to me like Global Crossing. Global Crossing bet on the internet boom and the physical aspects of the internet boom, and they were going to lay cable and do all kinds of things that were on the physical side because we were going to have to use the internet, and the internet activity was going to explode. And they were right about all of that, but they still exceeded with too much capacity for the pace of the technological adoption, and they went out of business. So what's going on here with the hyperscalers? On this chart anyway, only the Louisiana Purchase is a bigger investment when most of the land west of the Mississippi was purchased from Napoleon in 1803. So, you see here some of these other big things like U.S. railroads from in the 1850s. Even that was a smaller investment than the data centers. So you've really got this frenzy going on especially from these firms that have a lot of cash that they can put into this. You're building physical capacity for a product that doesn't really have a revenue stream, at least as of today. I think this is a concern that this is going too far, too fast. It's a good idea. The technology is going to be great. It is going to transform the economy, but there still is such a thing as going too far, too fast. On labor markets, I think you have to consider the immigration policy of the U.S., which has changed dramatically. And this is a study by Wilson and Zhao from the San Francisco Fed, and this is their key picture. Those circles represent metropolitan statistical areas that might hire or been known to hire undocumented workers in the U.S. And the blue line, the blue is the high growth period for undocumented workers in 23 and 24. And the green is the slower growth of undocumented workers in 24 and 25. And these places reported high growth in jobs in the earlier era and low growth in jobs in the later era. So what this is saying, and those slopes of those lines there are essentially one. So this is actually saying that the decrease in jobs reported is basically 1-for-1 with the amount of undocumented workers allowed in the U.S. Now, of course, the new administration, this has been one of their key issues, is to stop undocumented workers from coming into the U.S., so you're basically on the low line here. And so what's happening is that the run rate for non-farm payroll job growth in the U.S., everybody in this room used to think about, 150,000 or something like that was kind of a good number or an ordinary number for non-farm payroll employment growth in a particular month. That has shot down dramatically, down to maybe 30,000 per month, some even say 0. So I think this is just dramatically changing how we can interpret our key indicator, the non-farm payroll numbers. So I think you have to focus on unemployment in the U.S., which is close to the natural rate, weekly initial unemployment insurance claims, super low. So those two indicators seem to indicate health in the labor market. I think, unfortunately, that the non-farm payrolls is difficult to interpret right now, and this study does a great microeconomic job of documenting that. On inflation, U.S. is still above target. This is the Fed's preferred measure of inflation, core PCE inflation measured from 1 year ago. On the left-hand part of this chart in 2023, you can see it was quite high and came down sharply in 2023, but only to 3% or high 2% range. And now when you get over on the right-hand part of this chart, which is the most recent data, this has crept up now above 3% once again. So really no progress on inflation according to the committee's key measure for over 2 years. This is a concern, and I think the committee's going to have to get tougher on inflation because of this. You might say, and Madame Lagarde and Philip Lane talked about a lot about inflation expectations. Here's another take on inflation expectations. This is the TIPS market in the U.S., 5-year break-even inflation rate. This is one of the measures I like to look at because it's a market-based measure and it's sensitive to incoming data. And you can see here that it has, at times during 2025, been below, 2.4, 2.3%, which I would consider a healthy number. But when you get over to the right-hand part of this chart, and especially in March here, this is daily data. This has shot up again. So again, I think you're at risk that the inflation expectations would start to move up more sharply as this shock propagates through the U.S. economy. And so I think this bears watching. It's volatile, so you never know, but it certainly looks on the right-hand side like inflation has become more of a concern in markets. Monetary policy expectations have also altered. This is, again, daily data. This is a 2-year Treasury yield nominal. And so this goes back to the Trump election day, actually, daily data. So this is, this has been drifting down as we've gone through 2025 and as the committee lowered the policy rate by 75 basis points. A lot of that was anticipated by markets, and so this went down sooner than the actual policy moves were made. But you can see that this has stalled out on the right-hand part of this chart and actually moved sharply higher in most recent trading sessions. So I think policy expectations have definitely turned around. Many of you are intimately involved with this in markets, but this is the idea is that the Fed would be able to ease further, I think, has greatly diminished just in the last couple of weeks as the war got going and the oil shock got going. Let me talk about central bank independence and maybe one other issue, and then I'll wrap up. As you guys know, the Fed's under a lot of pressure politically. So I'll just reiterate for this audience that everything that goes on at the Fed comes from the Federal Reserve Act. As it does at the ECB, it all comes from the treaty, but in the US, it all comes from the Federal Reserve Act. The Congress could change that act at any point. They have not wanted to do that historically. It would take 60 votes in the Senate. The act insulates the Fed from day-to-day politics. It's not really independent from politics. After all, you have political appointees at the Board of Governors that are making a lot of the decisions. But it does have many provisions that protect the Fed from day-to-day political wrangling. The administration has put heavy pressure on the Fed, but not unprecedented pressure. We did have others like Lyndon Johnson and Richard Nixon who also put heavy pressure on the Fed. And I would say every White House put some pressure on the Fed, but this has been unusually heavy. Pressure for lower nominal interest rates. I would also say that partisans that win an election often feel that they should get to control interest rate policy because they won the election, but the Federal Reserve Act governs that, and the Federal Reserve Act says, no, you don't get to do that. We're going to do that in a more organized way. I think that Chair Powell, and this is just Jim's opinion here, but I think Chair Powell saw the criminal threats, criminal prosecution threats as crossing a red line. I think he, I don't want to put words in his mouth, but the interpretation would be that if any partisan in Washington on either side could just make charges against somebody that was on the Open Market Committee, and therefore that person would have to step down regardless of the truth of those charges, that would basically eviscerate the protections around the Fed. So the Federal Reserve Act would still be there, but you wouldn't have any protection at that point. Senator Tillis of North Carolina has agreed with this and is now blocking everything from going through the Senate Banking Committee with respect to Fed appointments. So as it stands today, there will be no appointments of any kind to the Fed. There will be no personnel changes of any kind because you can't get through the Banking Committee without Senator Tillis. Tillis is not running for re-election, so he will be there until next January. This is also making it increasingly likely, I think, that Jay Powell will stay on the committee as a board member, but even after he's done being chair. And I think that could be a moderating force on U.S. monetary policy over the next 2 years. We'll see how this develops. The White House could make a deal. They could get everything to happen, but they don't seem inclined to go in that direction. And so this is becoming a more and more likely scenario. Risk from the war, and I'm sure we'll talk more about this in the open session here, but this is a chart, again, from Goldman Sachs. On the right-hand side, you have effects on U.S. headline inflation of a 10% increase in oil prices, and the answer, depending on which measure you use, looks like about 25 basis points. On the left part of this chart is the impact on core inflation. Of course, core inflation is throwing out the energy component. You would think it would be zero impact. It's not quite zero. It's still about 4 basis points. But the committee already looks through the headline inflation and looks to core inflation. So the key thing would be the left-hand part of this chart. And I think the message is you would need a very substantial increase in oil prices to really see a lot of impact on core measures of inflation, unless inflation expectations really ramp up dramatically. which could happen, but, and I showed you the inflation expectations chart earlier. Okay, so thanks very much. I appreciate your attention. I appreciate the invitation to be here. I'm looking forward to the discussion. Thank you.
Thanks a lot, James. And the next speaker is Frank Smets.
Well, first of all, it's a great pleasure to be back in Frankfurt and see so many friends. It's also a great honor to be on a panel with Philip and Jim. So I will take a global perspective on the risks to the inflation outlook. And I will do that in two parts. I mean, first I will also sort of take stock of how the world looked like before the start of the conflict in the Middle East. And then I'll have some reflections on the most recent shock, and particularly the effect on the energy markets and how that affects inflation and monetary policy. Here my remarks will very much actually echo President Lagarde's. I did not coordinate, but it may not be surprising maybe either. So where were we at the beginning of this year? I mean, global inflation was almost at or very close to targets. I mean, the first graph here gives you one measure of global inflation and basically the three main moments: the mean, the standard deviation, and skewness. And you see the mean is at 0, basically means at target. The skew is basically at 0, meaning the risks for global inflation are balanced. And the variance, this is the blue line, is basically back to normal. Of course, there are differences across countries, and you see some of those differences on the right-hand side, with the US, the UK approaching the target from above, the ECB basically at target, Japan close to target. Some countries had rising inflation, like Australia, which is the last bar on the left side, and not surprisingly, the RBA did raise interest rates. Was one of the few central banks that raised interest rates. If you look at expectations, basically the same picture, no? Consensus forecast, so these are professional forecasters. Basically, they're back at target, and with some variation that you see, but not unusual. We've already seen break-even inflation rates. I mean, an amazing sort of convergence to targets across the main advanced economies towards the end of 2025. I mean, the only expectation to pause is households' forecasts. I mean, as you see, they have not come back to the targets, so these are all deviations from targets. They're still, on average, again, this is across countries, around 2 percentage points above 0. And that, of course, is a sign of the scars that the previous post-pandemic inflation surge has left, and is one of the vulnerabilities we have to think about when thinking about what will the current increase in energy prices do. Now, Volker mentioned good times, or times when things look in a good place, are the times when you think about risks and how to do risks. Now, one way to do that is develop scenarios, as you mentioned, do what if a war happens in Iran. Another way that econometricians like is to actually go back over the last 3 decades and ask the question, well, what are sort of the proximate variables, the proximate determinants that have led to significant increases in inflation? And so this is basically sort of one way of showing some of the outputs from this analysis. It shows the effect of each of those proximate determinants of a one standard deviation shock, like a sort of a normal deviation on inflation the 1 year ahead. I mean, the first thing to get from this picture is that inflation is a slow-moving process. The best determinant of future inflation is current inflation. That's the first line, which is very good if you're at target. It's not so good if you're not at target. The classic Phillips curve determines, I mean, they don't move inflation very much according to this analysis. The slope of the Phillips curve, so the the output gap effect are very small. So it's a lot. In open economies, the real effective exchange rate does matter. Then in the second panel, you have some of the external drivers that we found are significant. And of course, global energy prices is a very important source of variation in inflation. Another one is the US dollar index, particularly if the dollar is strong. In general, financial conditions in the world are tighter, and that has a negative impact on inflation. These are the external factors. Now, the right-hand side basically gives you the domestic factors, and particularly the policy-related factors. And I think this is something that we really need to watch when thinking about what will be the implications of the energy price shock for inflation. Financial conditions are key. So if you have very tight financial conditions, if this shock would lead to financial crisis, then you will have big disinflationary pressures on inflation. Fiscal policy has also very important impact. If fiscal policy is very loose, then actually inflation will rise. And so what you see in this, and I didn't really explain this, but it's a nonlinear effect. So if fiscal policy is very loose, the effect on inflation will be much larger than sort of a normal reaction. And of course, this is an econometric exercise, it comes to some extent from the experience during the pandemic crisis. And now there's another way you can try to think about what's going to happen in the world, and that's reading the newspaper, or at least let a large language model read the newspaper. And so this is an index that we developed with colleagues at the BIS, where we basically ask an LLM to read through the Wall Street Journal articles and say what is the sentiment on inflation. Is it more like inflationary sentiment, meaning inflation will rise, or is it the article captures more disinflationary sentiment? And the good thing with LLMs is that you can actually also ask, so what's the narrative behind it? Is it more demand-driven, or is it more supply-driven? And so this index basically shows if it's positive, basically it means inflationary narratives. If it's negative, it's disinflationary narratives. The blue bars are sort of typical demand narratives behind this. The orange bars are typical supply narratives behind the inflation pressure, so cost pressures if it's positive. And so one thing I just want to take away from this graph is that obviously the orange has become much more important since basically in the last decade. Now the good thing from such an index is that actually you can do it real time and on a weekly level, and this is what I show here starting in the beginning of 2025. I mean, the dark orange, that's basically tariff policies by US administration. So obviously that was the talk of the town during most of 2025. Then it sort of disappeared for a while, and the last 3 weeks, these are the last 3 observations, what's back, not surprisingly, commodity price narratives and supply chain disruption scenarios. That's the orange part. Now, these are stagflationary narratives. No? So if you do the same thing for growth, you will get a negative effect on growth, and you see sort of the initial negative effects at the end. Now, how have markets sort of interpreted the impact of the conflict in the Middle East on energy markets and what it means for inflation and policy? And we've heard already about this both by the President, by Philip, and also by Jim. I mean, on the left-hand side, you have the change in the futures curve for gas and oil. The middle panel gives you the change in the inflation swap curve for Japan, the US, red, and the euro area, blue. And the right-hand panel gives you the change in the forward interest rate curve for the same countries. Just a few observations first, and this is the change from before the start of the war to basically 2 days ago. No? So the first thing that you see is that gas prices have increased, relatively speaking, by much more than oil prices, and they are expected to stay high. Again, this is a snapshot 2 days ago. They are expected to stay high for at least a year, which, of course, makes us pause before coming back to zero or closer to what they were before. And of course, we know that the euro area is particularly sensitive to this rise in asset prices and gas prices because they import quite a bit. And so it's not surprisingly that markets think that, at least in the short term, inflation will rise more than in the US, which is the red line, and Japan, where the impact is actually relatively mild. And it's also not surprising that then markets expect that the interest rate increase, the nominal interest rate increase, will be higher in the euro area, again, the blue line relative to the US. Now, it's a gradual, no, it's basically an expectation of 325 basis points increases over the next year. So the question is, okay, what determines both the inflation effects and the interest rate responses? I should say, if you do that same picture for the Russian invasion, for the euro area, actually, you get very similar effects on inflation. If you take a 1-month window after the Russian invasion, for the expected nominal interest rate response, you get a very different. Basically, there was no expected response, which I think was part of the forward guidance at that time. So how to respond? And again, the president was much more eloquent on this than I can be. I mean, one approach to confront supply shocks, such as energy prices, is to look through them, at least to some extent, because the effects on inflation are often short-lived. Monetary policy takes time to have effect, and they give rise to a policy trade-off between stabilizing inflation and economic activity. These shocks are typically stagflationary. But if the effects on inflation is likely to be persistent due to second-round effects or indirect effects, a preemptive tightening may be appropriate. So what did central banks do in the past? And there's some interesting work by colleagues of mine, Hoffman, Manet, and Mongeon, that basically tested this hypothesis of look-through. So if you estimate, and this is basically an average for these 7 advanced economies, but you basically get the same results if you do it for each country separately. You find if you do a classic conventional Taylor rule, you find the usual coefficients. No, the middle one is the reaction coefficient to inflation. It satisfies the Taylor principle, so it's greater than 1, but you also have a significant response to output gap, and there's interest rate smoothing, which is the gray barred, a little bit less than 1. So there's gradualism typically in central bank's reaction function. If you now try to split the inflation in demand versus supply-driven inflation, and of course there are different ways in which one can do that. The results they show in this paper are quite robust to how you do that decomposition. You do get a very different reaction to demand-driven inflation, which has a coefficient of 3, versus supply-driven inflation, which has a coefficient less than 1. So, which basically, I mean, I'm not sure this is not really looking through, that is not doing anything, and I think you made that point. You still are capturing some of the nominal increase, but much less than if it's demand shock. Oops. Now, of course, this is on average, and the president said the response has to be context-specific and particularly will depend on the likelihood of second-round effects. There is a very interesting BIS bulletin published early last year in 25, Avalos et al., that actually goes through, I mean, it's about the impact of commodity price shocks, and it goes through whether there is actually econometric evidence that those various factors that the president mentioned lead to different effects on inflation, both in terms of the size of the effect and the persistence of the effect. It shows that, obviously, the size and duration of the shock does matter. And it shows that there are nonlinearities, very much like the ECB work that was highlighted by Phil. It shows that the structure of the economy is very important, particularly the share of energy in consumption and production, as we would expect, because that determines the indirect effects, but also whether you're a net importer versus a net export. If you're a net importer, the effect on inflation is higher and more persistent. So, and then it also shows that initial conditions matter a lot. The initial inflation outlook, where you are relative to your target, the credibility of the monetary policy regime, the situation of the labor market, and also fiscal policy. Let me just, I won't go through all the results, let me just pick one graph from that type of work, which shows you the impact of some of the initial conditions. If inflation expectations are above target, you almost have triple the effect on inflation of a 10% shock in oil prices, in this case, than if they are below target. If the labor market is hot, again, you have double the effect of commodity prices on inflation the next year relative to a more weaker labor market. And again, last but not least, the fiscal balance matter a lot. And again, we've heard that before. If fiscal policy is loose, going into the shock, then the effect on inflation will be much larger than, and significantly larger than if fiscal policy is tight. So the effects are very much context specific, and of course the policy response will have to be geared towards the assessment of the importance of those factors and how they affect the expected impact on inflation. Let me just finish by saying, now, of course we don't really know. We know what the initial conditions are, so we can make an assessment of whether it's more likely that you will see second round effects or not. And again, we can go through this list and sort of apply it to the euro area. But there's also a lot of uncertainty, and particularly uncertainty about the source of the shock, which is the intensity and the persistence of the conflict and its impact on energy markets, but not only energy markets, also other important markets like for fertilizers. When you have this high uncertainty, I mean, typically it warrants greater attention to incoming data, so that's the meeting-by-meeting approach, and also wait and see attitude, in the sense that you're waiting for new information in order to calibrate the appropriate policy. But we know that if the risks tilt towards more persistent inflation, then preemptive tightening may help stabilize inflation and inflation expectations and avoid more costly tightening, aggressive tightening later. And of course, that's exactly the sort of the dilemma that central banks all over the world, and including the ECB, are now facing. Effectively communicating on uncertainty can be challenging, and we've heard the president speak, we've heard Philip speak. It's really about sort of communicating that uncertainty, and scenarios can definitely enhance public understanding. I mean, one question I have, and the ECB was really on top, and I applaud my former colleagues for doing this at such short notice in terms of showing these scenarios. But there's a question about, should you also show the interest rate response in those scenarios? We have a research bulletin, a quarterly bulletin article in the last quarterly review, which goes through the practices on scenarios and communication of central banks in that respect. And the use of scenarios is increasing. Also, the use of scenarios with an endogenous policy reaction is increasing. But there's actually very few central banks that do the latter. And there are good reasons why. I mean, the costs and benefits are not necessarily very clear. So let me stop here.
We have now time to open the floor for questions. And as always, we start with lead questions by some particular experts from different institutions. So today we have in our session here Katharine Neiss from PGIM, Sarah Schmidtke from Bankenverband Mitte, Julian Callow from Rokos Capital, and Sylvain Broyer from S&P Capital. And I would like to probably start that you ask all your questions. Maybe you indicate to whom you're addressing the question, and then after we collected the questions, the floor would be yours to respond. And then depending on time, we will have a room for more questions from the audience. So please, Katharine, if you would like to start.
Thank you. Are you sure it's on? Yeah, okay. Thank you for an excellent start to today's Watchers Conference. I wanted actually to direct my question to a chart, Frank, that you showed at the end of your presentation on the impact of fiscal policy and the differential effect of inflation in that sort of an environment. And maybe direct one part of my question to James, if I may, about sort of general lessons that we may have learned. I mean, very crudely speaking, many have argued that fiscal policy was insufficient after the GFC, but maybe too much after COVID and the energy shock of 2022. So what lessons might we have learned about how we can better coordinate fiscal and monetary policies in these sort of crisis moments? And then maybe a related question to Phil as to what sorts of indicators do you think that the Governing Council will be looking at specifically to try to assess how fiscal developments evolved and impact on the ECB's decision-making for monetary policy? Thank you.
Yeah, thank you very much also from my side for these insightful presentations. I have a question for Philip Lane, referring to your presentation, James Bullard, on AI, because I would like to ask you, how do you model the impact of AI on the labor market and productivity, and ultimately on economic growth expectations? What's your take on the impact of AI? Thank you.
Yeah, I'd like to endorse really excellent presentations and speech by the President earlier. I think we all feel much better informed about the reaction function. And I also note the continuity with this event 1 year ago when the President was speaking about the need to have an alert strategy, and we seem to be in a position now to see what that means in practice. It's a fantastic panel here with great experience internationally. So I'm interested to know what lessons might be learned also in terms of how things have developed since 22, in particular looking at the differences in the way we're seeing the central banks in the United States and here in the euro area actually operating their policy. It seems to be quite a lot of significant difference if we compare the three presentations. So I'd be very interested to learn more about what potential divergences we might need to look out for in terms of how monetary policy is being set over coming years. Thank you.
Thank you very much for this excellent panel and presentations. I have a question related to forward guidance conditional to the scenario analysis that is made. So it has been reiterated at the latest press conference and today by Madame la Présidente that the ECB will continue to take decisions on a meeting-by-meeting approach, relying on data without committing to any particular interest rate path. So, in other words, the ECB does not provide much forward guidance to remain agile in the context of supply shock. The ECB is also not alone in this. And in the latest BIS review, there's an article saying that central banks in general are providing less descriptive policy guidance than before. But at the same time, and as the saying goes, nature abhors a vacuum. Markets have priced in monetary policy tightening of around 50 to 75 basis points in the next 12 months. So would you say that markets have priced in the ECB adverse scenario or the baseline scenario? So the question is therefore, in the current environment of high uncertainty linked to a supply shock, would it be useful or not useful for the ECB to offer somewhat more precise forward guidance? For example, the interest rate path associated to the scenarios you have produced. And if I may add, I would like to thank the ECB, the staff, you, and to congratulate them for producing in a very short time so much useful materials for us. Thank you very much.
Thanks a lot. I guess we could start with Jim. Although you had the first.
Great, thanks, and thanks for the great questions. On the general lessons from fiscal policy in the last run-up to inflation, I do think a fruitful way to think about the 21-22 inflation, 2023 inflation, especially in the US, but around the world, is that you think of COVID as a war. It's not a military war, but it's a war against the virus. You had a lot of fiscal action around the world to try to counteract that. And you had very low interest rates, certainly in the US, but elsewhere as well. And that sounds like a war scenario. In a war, historically, the society is very upset. The parliament or the king starts spending a lot of money without really knowing where the future taxes are going to come from. The central bank is asked to accommodate the war effort with low interest rates. This is known to produce inflation in many different times and places, many different institutions. So I think the core lesson from 21 and 22 is that indeed happened again. And we got a lot of inflation in the post as we were trying to come out of COVID. So I think that is the central lesson. Certainly in the US, you had the initial response to COVID in March and April of 2020, which was a lot of fiscal spending. But then you had that followed up with equal amounts of federal spending, not backed by future taxes, and continued low interest rates all the way through 2020 and all the way through 2021. So, that produced a lot of inflation. I think I would point you to John Cochrane, who's one that has told this story. I've told this story also. So I think that's the central lesson. We had to move very quickly in monetary policy in 2022. And I think the very aggressive response at that point was appropriate, and we got out of the inflation without having a recession in the US. So I thought that was a very important lesson, that if you moved quickly and with clear understanding in financial markets about what was happening, you could get rid of the inflation without having a recession. And that was very contrary to what many people thought was possible at that time. So I think those are some of the lessons. I mean, where are we today? I think initial conditions are just dramatically different from where we were at that point. So at that point, we got a huge shock that called for fiscal action and called for, or appeared to call for very low nominal interest rates as well. Here you've got inflation closer to target. You've got, it's not clear that you'll have as much fiscal action, and you've got more scope to interest rates are not pinned down at the zero bound, so you've got more scope, I think, to react with ordinary interest rate policy compared to 2022. So on the forward guidance question, I really don't think at a practical level that this is a good time to be offering forward guidance. Probably scenario analysis is more appropriate in this at this juncture, and certainly Philip Lane talked about that. I think I appreciate the comment that nature abhors a vacuum. Markets have to have an expectation. They have to put prices out there. I would say that the one form of forward guidance is to communicate a policy rule, so the scenario analysis can inform markets. Well, if the developments go in this way, then we'll react this way. If developments go in another way, we'll react another way. And then markets can put probabilities on those different scenarios and eventually get to some prices that might make sense, even though uncertainty is very high. So I think there is some scope for forward guidance in that sense, but it's going to be less satisfactory than it would be in ordinary times.
Okay, thank you for the questions and the interest. On the AI question, I need to come back to it because I only had time to write a very short speech on Monday on AI. But at some point I will give a more complete answer. But with that short speech on Monday, I basically tried to describe what we're seeing so far. And AI it's in the data. It's noticeable. It is boosting investment and productivity, I think, in the area. But it's early days. So there's a very wide range of possible futures. One point I tried to emphasize in that speech is we live in a world economy. So in terms of AI is a global, knowledge is a global public good. Of course, some companies will try to capture the knowledge and kind of charge fees for that and so on. But I think understanding that over the next decade there will be, a substantial improvement in productivity from AI, absolutely. I did take on the monetary policy implications of AI in that speech, and I came down very decisively on a two-handed answer. So I'm decisively unclear about the future on that. And so maybe that kind of is a natural segue into the rate paths and the scenarios. And this has been a kind of a very popular comment. I'm pretty sure I got it at this conference before. And what I would say, and I kind of wrote it up in more detail at the Thomas Laback conference last year, so you can find my speech about communication under uncertainty, where, of course, internally you can expect that the experts at the ECB do generate rate paths for all the scenarios and so on. But remember, first of all, the projections are the staff projections, and those rate simulations are the staff rate simulations. And essentially, I think, but maybe Frank knows more than I do, I'm not noticing with other central banks that they go beyond, according to our models, here's how monetary policy would react under these scenarios. I got a comment last year that, why don't you tell us in more detail about the models? We listened, and we did publish, there's a working paper from last September, which goes into immense detail about the construction and the code underlying the multi-country model of the ECB. That's just one model we use. But we are trying to keep you employed. We're trying to keep a role for economists working in the private sector, where you can generate your favorite models, you can add in your judgment. But I really think, because it's inescapable, it's inevitable. You may say, I understand conditional guidance. Lots of people out there don't, and they'll say, you promised us this rate path. I bought a house on the basis of that rate path. And now the rate path is going to be different. How dare you? So, it's just not helpful. And I think, it's very good idea for us to focus on each meeting to make the immediate decision. To make the immediate decision, you don't need to know the whole, or take a stand about what is going to be the future rate path. You basically need to meet a threshold of, okay, incrementally, I think we can move up. I see Stefan Gerlach in the audience, and Stefan when I was an editor of economic policy maybe 15 years ago, there was a nice paper about modelling interest rate decisions as basically a probit. It's a 0-1. You either make a decision or you don't. That is essentially what we have to do in a given meeting, not describe the whole future rate path. Clearly, if the market, so let me stop on that one. On fiscal, let me say two things. One is, I think for advanced economies, I'm going to be in the camp of saying you can just go a long way by viewing fiscal as kind of contributing to the overall level of demand. I don't think it's necessary to start wondering about the underpinnings of price stability. And then in terms of what we're seeing now, this is one value of the Euro system, to have all of the national central banks who are able to track every individual fiscal measure day by day, hour by hour. So we will have a very good understanding of the hundreds of measures we had last time, and essentially working out what is the net impulse to demand and what is the net effect on the consumer prices. Because some of these are price-suppressing measures, indirect taxes, and so on. So maybe I will stop there.
Yeah, maybe just quickly first on fiscal. I mean, I do think that is a risk, as I also highlighted in my presentation. It is one of those factors that they are benign as long as they're benign, but when sustainability or that is put into question, then you can get nonlinear effects. And I think the experience from the pandemic crisis is that when you try to look across countries with the inflation experience, you can correlate it to how loose fiscal policy was. So that is an important factor. Having said that, I mean, it's natural for governments to take care of the people that are most hurt, but you can do that through more targeted and temporary measures and redistributive measures rather than by having a big overall fiscal expansion. On the issue of forward guidance, I mean, Bank of England, just in response to the Bernanke review, started publishing scenarios, and they have a whole bunch of policy rules that they use to in the context of those scenarios, and particularly two policy rules to sort of show how these scenarios may have an impact on inflation, on the outlook. But it's true that if you look across central banks in the world, it has been increasing, but it is still an exception. And I think there are good reasons, pro and con. As Ben Bernanke emphasized, doing an endogenous policy scenario helps communicating the reaction function. But there are other ways of doing that, and the ECB has these three elements, which I think is another way of doing that. But if you're really interested in showing extreme scenarios, the Bank of England scenarios are relatively minor alternatives around the baseline. If you really want to have a really adverse scenario like the ECB, I mean, then the risk that there will be too much attention on what that scenario means for monetary policy, and there will be too much weight on it, I think is high. And so that's a factor that I think makes central banks be a little bit hesitant to do that. Because there's these two roles of scenarios. One is to really show what are the risks and be careful, don't put too much weight on the central scenario. Another one is to show the reaction function. But I think you need different types of scenarios depending on what you want to emphasize.
Okay, thank you very much. Thanks for the answers. Thanks for the first round of questions. I think we have time for a few questions. I would maybe start taking 2 questions if there are. Yours, please.
I have a question for Philip Lane. Actually, do you have estimates, fact-based of course, concerning the time lag between policy measures and the effectiveness when it has an impact on the inflation rate. The reason for this question is, of course, very easy. You all know that you reacted very lately at the last crisis, and even the other day, your colleague, Professor Schnabel, admitted that you have been far too late. She said, of course, she was the first to raise her finger, but the executive board, the executive was not ready to act early enough. So, and then, you know, you in your diagrams, you showed that we were close to 7% inflation rate. And then you said, well, it went down very fast, so okay, so it was not too problematic. However, I mean, if you ask normal people in the street, they say we are on a much higher level. And on top of that, we have a low inflation rate, 2% or whatever. But that, of course, is then 9% roughly higher. So communication is indeed a very important thing. So please tell us what you think about time lags. That's very important.
Okay, I think I would pick one more question now, and then we answer together. Ulrike Neiss, please.
Thanks a lot. So my name is Ulrike Neiss, University of Düsseldorf, and I have a kind of a practical question, because in all speeches and all presentations, central bankers always say yes, uncertainty increased so much, and therefore we have a database from meeting to meeting decisions. And against this background, my question is: have you ever decided to have the monetary policy meetings, for example, every 4 weeks instead of every 6 weeks? Because it seems to be that you have a for example, if you made the decision last week, I mean, it's totally clear that to wait for 6 weeks now, it seems to be rather long in such a high uncertainty meeting. So a more practical question, perhaps to Philip Lane.
Thanks a lot. Please.
Okay, that's a really good question. And I'm looking at my predecessor, Otmar Issing, who I believe did have you had meetings every month originally at the ECB. And maybe I should hand over the microphone to Otmar on that. But I don't think the staff would thank me. The staff, and clearly the issue is noise signal. You know, and maybe I'll come back. That gives me an opportunity to come back to this issue about the role of scenarios, the role of baselines, forecasts, and so on. Because essentially, at any given meeting, we do have all of that point-in-time information. But the next meeting, we know it's going to be different. And again, one reason why not to overly dwell, say, on the model implied optimal policies. I mean, as Frank said, I mean, central banks do put out, but the question is, how informative is that about the actual decision making? Because I don't recall any of my governing council colleagues saying, the model says it must be true. You know, there's a whole range of considerations. And let me give you a practical consideration. Last autumn, or a good chunk last year, we did have a near-term undershooting of the target. And when you looked at it, it's basically a lot of energy deflation. So, you know, the issue there would have been, okay, do we believe, given everything in the world that's going on, that energy deflation is something you can rely on? And in a geopolitical world, the risk, which is now unfortunately materialized, of a big shock to energy is something that you know, would mean that you say, okay, thank you for all these rate simulations, but I need to keep an eye on the wider picture. And this is why having a diverse governing council, I think, is important. We tried to, I think I have memories of previous appearances here, and maybe the same person asking me similar questions. And we've tried to be very transparent at ECB. The staff, you know, has published a lot, looking back at that episode, and I think other people have done it as well. And essentially, the contribution of monetary policy to the peak inflation and persistence of inflation, it's not zero. So again, what we say is, if we had had complete information, we would have made different choices. But again, I'm looking around the room about an amount of ex-post people said, well, I knew this was going to happen. But again, when I look at all the publications of everyone else, I look at market pricing, it's not the case that there was I think ex-ante major differences with our ex-ante views. So the lags are there in terms of affecting the economy. But one thing I think it's fair to say, and there's a nice sentence in President Lagarde's speech, is the sensitivity of expectations doesn't rely on actually monetary policy hitting the economy via bank-based transmission, via slowing down demand. There's a direct channel to the market. So this idea of unless you react, there's a bit of uncertainty, about are you. On the other hand, I think people also understand the exact timing of a reaction. There's a lot of considerations there. And again, the basics of is there, and going back to Stefan's work, basically at any given meeting, it's a kind of option issue. Do we go now or do we wait a few weeks? And macroeconomically, we have quarterly models. Going back to your question, we have 8 meetings a year. And so in terms of quarterly interest rate paths, essentially you have 2 goes at every quarter. So there's a lot of tactics as well. But maybe I'll stop there.
Yeah, I just wanted to comment on the practicality of meeting more often. I don't think it's very practical. I like the 8 meetings a year, maybe just because I got used to it. But to me, a meeting is like a checkpoint. And you're kind of, everyone that's on the committee and all the staff, they're all following all the developments all the time. So in some sense, this is going on every day, but you want to hear what everyone else is thinking. And the other point I would make is, at least for the FOMC, out-of-sequence meetings are not unheard of. They can occur, and they did occur, quite often actually during the global financial crisis. And again, during the pandemic, at one point, the FOMC met on a Sunday when they had a scheduled meeting. We had a scheduled meeting on Tuesday, Wednesday of that week, but no, because things were moving so quickly, we met on the Sunday and reduced the policy rate down to 0 right then. And you might have said, well, why can't you wait 2 days? Well, things were moving extremely quickly. So I think the committee can respond and does respond in real time, and so I think we're not, even though there's a regular, these checkpoint meetings are on a regular schedule, that doesn't mean that, monetary policy can't move with alacrity when the situation calls for it.
Thanks a lot. We are a little bit over time, and I think as a favor to the next sessions, I should stop here. And thank you all very much for your questions and the panel for their presentations. Thank you.